think we got to start off with this Fed meeting that kicks off today. What's your expectations from the Fed? Obviously, we get the decision tomorrow afternoon at 2 p.m. Eastern. How big of an impact do you believe the global banking crisis will have on the ultimate decision from our central bank?
Yeah, well, if you recall, just over 2 weeks ago, just around 2 weeks ago, Powell had given a fairly hawkish testimony to government and really indicated they could be shifting to a more hawkish path. And at that point, markets had started to price in a 50 basis point hike. So it kind of returned to those larger hikes that we had seen in previous months. The banking crisis, I think, has fundamentally changed a lot of that narrative. It's quite difficult to know at this stage how the Fed is going to be responding. But the market stability over the last day or so will certainly be very reassuring. And it does suggest that they will continue with their hiking path, but they'll probably do a 0.25% increase rather than that 50 basis point one. So, more of the standard, but trying to focus on price stability. So still talking about the inflation fight, but also with some kind of acknowledgement of the various concerns that are going on in the banking system. The other part of this is we're not expecting them to provide any kind of forward guidance, really to emphasize the data dependency, the market dependency of their future decisions.
Yeah, data dependency seems to really be the theme, and stability. I think people are looking for stability in every kind of market and stability in every kind of way. I want to run some new data by you. All right, some new data from Refinitiv shows that investors are wasting no time and they're just flocking into cash. Inflows into money market mutual funds last week, they topped $108 billion. We're showing a graphic to our viewers right now, Seema. This is the fifth largest net weekly inflow on record, going all the way back to 1992, according to Refinitiv. What does that tell you about investor sentiment?
Well, look, I think investors have been quite frightened by the last week or so of the news that's been streaming out. Look, I think clearly things have been quite concerning. We've seen a lot of damage done to sentiment. That doesn't mean that it has to continue like this. I think what we have seen from policymakers is that they have tried to ring fence a lot of the issues in the banking sector, and they continue to look at new ways of ensuring that this doesn't turn into a big contagion banking crisis. But inevitably, once you have the Federal Reserve, the European Central Bank continuing to raise rates, it does mean that investor sentiment is going to be a little bit more pessimistic going forward. And unfortunately, that does inevitably lead into the market. So okay. I wouldn't expect this to continue, but I'm not surprised by that movement.
Seema, we're clearly at an inflection point when it comes to portfolio management for people like you that manage portfolios. We're well past the TINA trade. There is no alternative than equities. When we're talking about bonds and also other vehicles for investors to kind of get away from the risk of equities, what percentage of a portfolio do you believe should be in a bond, whether it's short-term or long-term, or a money market fund or a mutual fund? I mean, right now, how are you guiding?
So we moved to an overweight in the bond space several months ago, really over concerns of what could happen to the economy, what can happen with central bank rates. So we do think this is a time to be focused more in the fixed income space. But again, within the fixed income space, really focusing on higher quality, more defensive assets. So that's your core fixed income. That's treasuries, that's mortgage-backed securities, that's investment grade. And certainly staying clear, at least for the time being, from things like high yield. These things, they do provide a bit of a yield, unlike we've had for several years now. Okay. They also should provide diversification in moments where you're seeing equity market stress.
But do you mean like a 60-40 portfolio with these bonds, or are you saying some other formulation here?
So I think the 60-40 is, of course, look, 60-40 last year had a terrible year. But we think that could have some space in this, given those diversification benefits. Okay. But actually, we think that there's, you need to look also outside of equity and fixed income. Think about real assets, so the alternative space, where you can actually get inflation mitigation, and that provides stability when things are getting really, really tough. So stuff like listed infrastructure typically do well in these kind of environments.